Welcome to Multifamily Method, a podcast which explores the state of the multifamily real estate market and some of the backgrounds, methodologies, and words of wisdom from some of today's most successful multifamily real estate entrepreneurs nationwide.
All right, well, everyone, I'm excited to have an esteemed guest, KC Conway, on the Multifamily Method podcast again today. It's been about a year since the last time we spoke. We're going to go back and revisit some of KC's predictions, what he got right, what's changed. We're going to predict the future as well. And just by way of introduction, for those of you who haven't met KC in the past, longtime friend of mine, someone I really admire and respect a lot. KC's worked alongside the Federal Reserve, worked in the banking industry, graduated from Emory, Chief Economist at CCIM, has worked alongside a number of REITs as well, and just brings a wealth of experience. And all around, just a great guy that I always enjoy our conversations, has a great sense of humor, wears a flashy pair of shoes. Red Shoe Economics is the name of his business. You see it there for those of you watching on YouTube right now. KC's definitely known for that throughout the country. Welcome, KC. Great to have you.
Thank you again. It's great to be with you again, Mike.
Absolutely. Absolutely. Well, let's go back to 2022 and talk about some of the predictions about a year ago at the recording of this podcast. We're in the middle of March of 23. And one of the things that you've been talking about for a number of years that I'm going to give you an A on is moving of the supply chain from north-south instead of west coast inland. And you talked about the ports in the Atlanta Fed. And boy, those ports have really surged in the last year. So that was a great prediction. Tell us a little bit about the supply chain and what's going on there.
No, great. And they finally, after 10 years, they listened to you, right? So I started at Colliers as their chief economist when we were expanding the Panama Canal. And I said, this is going to be a big deal, guys. They didn't believe me. They thought I was crazy. And so I reminded them, I am crazy, but I'm usually crazy right. So I think I was right on that one. So we are really rapidly rebuilding our supply chain from really LA, Long Beach concentric, moved to Chicago and spread throughout the eastern United States to a north-south. And to show you how rapidly this is changing, New York overtook LA and Long Beach as the busiest container port at the end of last year. And they have all the same problems, labor unions, not enough, automation and whatnot. So they did it. The other thing that's happened is the ports of Charleston and Savannah are just absolutely booming. And we're seeing the backlog of ships that were at LA and Long Beach, a year ago, Christmas, where we had over 100 ships backlog. This past Christmas, they had four ships backlog.
Wow.
So where'd all those ships go? They went to Port of Savannah, they went to Charleston, they went to the East and Gulf Coast ports. So Savannah just got all of its approvals and funding to go to 9 million containers within 24 months. So they will be the biggest and busiest container port, surpassing New York and LA Long Beach within 24 months. And so Savannah now is routinely running 30 to 40 ships backlogged when it never had more than 10. And those extra 30 ships all used to call on LA Long Beach. And what's happening is it is quicker to actually to move goods and merchandise and supply chain through the Suez Canal into the East Coast ports, because even though it's a few days longer sailing time, they can clear the ports of Savannah and Charleston and our Southeast ports in a day. It's all automated gantry cranes, paperwork. And so the executive director of the Port of LA Long Beach was on CNBC and Bloomberg a week ago. And he was talking about how bad things are out there. And Joe Kernan said, what's the cause? And he says, those darn East Coast ports, they move things at half the cost at twice the speed. So even if it takes 3 to 5 days longer to go to the Suez Canal, the net difference is instead of it taking 5 to 7 days to clear our port and a shorter sailing time, they're 2 to 3 days quicker, and they're right there at the population. So it is happening very quickly. All of our railroads, what I talked about, the Golden Triangle, where half our GDP and 70% of our manufacturing are from the Great Lakes down to Texas and through the Southeast. That's where it is. That's where all but one of our Class 1 railroads move. That's where all the supply chain's going. So it is happening very, very quickly. And that's a good thing for us, because that's one of those inflation things that can really help us out.
Yeah, great prediction. And that's definitely come true. I'm interested too. You mentioned Savannah. I know Charleston recently put over $1 billion into deepening their port and enhancing the capabilities there. Are you seeing that same surge in productivity in the Charleston port that you see in Savannah, Casey?
So Savannah won't be able to go as deep. They're a river port, and they can't go deeper than 47 because they puncture the limestone and the aquifers that go into the freshwater supply. But they can function very well. They got to close the river to two-way traffic. So what's happening is you're seeing Savannah go more to a lighter weight cargo. So doing more poultry, more pharmacy versus heavy goods. That heavy goods stuff is shifting to Charleston because they're a natural ocean port that's going to 52 feet. They've moved, given back almost all of their space downtown in Charleston, and they've moved further north into a new terminal space. They're doing very well. It's the fastest growing port on the East Coast. There are a little over 3 million containers. But here's the surprise one people need to be paying attention to is the Port of Mobile and Port Freeport. So Mobile has converted itself from a bulk cargo, moving coal and pulp and lumber, to Asia and Russia, to now a container port. And so they've got Airbus making all their airplanes down there. They've got Walmart that put its redundancy to Savannah there. They put in a new terminal for over 3 million containers. And the Port of Mobile will actually surpass the Port of Charleston probably within 2 years as having more containers than the Port of Charleston. And so last year we helped them get a new inland port in Montgomery, Alabama, which opens up the whole Mid-South to supply chain, which is incredible. And the other one is Port Freeport south of Houston. And it's going to become to Dallas what Savannah became to Atlanta. The Houston ship channel and Houston port do not want it congested with container ships messing up the energy and the chemical. So Port Freeport is filling that gap, and geographically it'll be the biggest port. The port director there, Phyllis Sadoff, is phenomenal. What they're doing, you need to visit the port site there. But Port Freeport south of Houston and Port of Mobile are the two up and coming ports that are going to just explode the whole Gulf Coast. And the other thing is, if you look at the Atlanta Fed District, which goes from New Orleans all the way around to Savannah, they have more ports in their district than any other Fed district, even more than San Francisco. They have 22. Guess how much research and reporting they do on ports and supply chain? Zero. You wonder why the Fed missed all supply chain inflation and whatnot. They don't even study it. And I did their signature work back in Hurricane Katrina when Bernanke contacted me and said, do ports affect GDP? I about fell out of my chair. So you wonder why the Fed missed it, but the redundancy with river ports, inland waterways, railroads, 5 of our 6 Class 1 railroads, now that we had Canadian Pacific and Kansas City Southern merge, all moved really the Gulf and the Southeast all the way into Canada. And that's where 70% of our population is, half our GDP, and where all of our supply chains being rebuilt. So it's an amazing story on the ports. You really need to dial in them, because if you don't know from your city inland, if you don't know what your rail and port connections are, you don't understand supply chain.
Yeah, so for the multifamily investors listening to this and manufactured housing investors, those are great markets to continue to look into in terms of job growth and prospects in the future, for sure. That's my takeaway there. All right, so we talked about the market movements of employees due to remote work phenomena driven by affordability, and COVID supercharged that. Has that shifting of population ended? Is that continuing? What do you see in the future for remote work and population shifts?
Yeah, and I really appreciate you asking that question. So it's on steroids. And I'll give you my favorite Christmas present, comes every year about the first or second week of January. It's the U-Haul moving report. And so U-Haul tells us where everybody moved last year. And like during COVID and even before COVID, they're all moving towards affordability and inland, and it's accelerated with remote work. And so the latest 2023 report for 2022 showed Texas and Florida back number 1 and 2. It showed all Southern and all inland mountain, and then a select group of Midwest markets like Ohio, Indiana, that are also getting a lot of the manufacturing supply chain. Columbus, Ohio is, Mr. Logistics in the Midwest, maybe as much as Chicago. And so U-Haul, they just showed us everybody's moving inland, and they're showing that the growth rates are like 7 to 12%, that the populations are moving from the West Coast, from the Northeast, from lack of affordability, and remote work enables that. So here's the phrase I've coined about remote work and office building that the CBRE hates me about, because they sell and market a lot of office buildings to institutional owners that they got to keep them in those office building assets. But remote work will be to office building values what e-commerce was to big box retail. And we're only in the first inning.
Wow.
And we're already starting to see New York with Vornado, California with Brookfield, Denver with Republic Plaza. We're seeing these big urban office buildings that have maturity and maturity risk. And the owners are just saying, we'll just give the keys back to securitization or whatnot, because we can't get anywhere close to half the value today. So we're just in the early stages of what we went through. And remember, in 2019, we peaked in big box retail store closings. and we hit over 9,000. And for every big box store in every mall, we have 10 times that in office buildings, big high-rise urban office buildings. So we have like 10 times the problem of what we went through with big box and mall retail. So this is going to be a big one. If you're an officer, you didn't take my advice a year ago, which was don't be scared, maybe be scared, but get prepared, get rid of the asset now. And so TREP did a good report on it. Every year they do their annual securitization report. And so their one for last year, it was titled Drama, Thriller, or Chainsaw Massacre. And their conclusion was, if it's office, it's a chainsaw massacre.
Okay. Well, I think that's going to drive more people towards probably the stronger asset classes of industrial multifamily. I don't see that trend changing anytime soon. Okay, great prediction.
And to your
there.
point on that,
Let's talk.
Urban Land Institute, which is a great organization, does their annual emerging trends report. So their 2023 one said, top 2 assets are multifamily and industrial. And for the first time ever, they moved hotel into number 3, and they dumped office and retail out of the top. It's never happened in their 25 plus year doing that report. So again, every ULI member, which really credible people on the ground and across the country, said, just put your money in industrial multifamily. Industrial, they have too many people chasing the deals. So multifamily is where you probably have a better chance, especially I think in the secondary markets, in the more interior where the institutional money hasn't quite figured out those dots yet.
Yeah, that's a great point. Okay. Inflation and the action of the Fed. So I'm going to back up to a year ago. You said they don't have the tools to handle this crisis. The playbook was wrong. So far, they've had, I'll call it moderate success. So I'm definitely going to give you at least a partial credit, at least a B+ on this prediction. But I also wonder, it was interesting. Recently, I was reading an old white paper by Milton Friedman, who talked about the effect of monetary policy on inflation. And he postulated it takes at least 12 months to see any impact. And Casey, it was a year ago that they started to raise these rates. So I think my question is, where's the Fed going from here? And have we even had enough time to see the impact of what they're trying to do?
Yeah, very, very insightful observation. So I tend to be about 6 to 12 months ahead of the market, because the market just looks at the headline. They don't read the footnotes. They don't connect all the dots. So remember where this Fed was. Go back 18 months, right? No inflation. Okay, maybe there's this thing called transitory. We're going to create this new word.
Right.
Then we're going to say, well, it's going longer than we thought, so we'll call it transitory longer. And then they said about another quarter later, could you forget we ever said transitory? And then you get to January, a year ago, January, and they said, oh my God, we really do have inflation. So that the January 2022 meeting, they said we should raise rates, but we're too chicken to scare the bond market. So in January, they did nothing. And then they get February off every year because they wait for the groundhog to see if he sees the inflation shadow. And man, he saw a redwood shadow in the background. So they come back in March and go, okay, we'll do a token increase. We don't want to scare the bond market. We'll do 25 basis points, and then we'll go away for spring break. And we'll hope that spring blooms and everything goes away. And they come back after the April spring break into May, and they're like, oh my God, we got to really go. We're going to be really, really spooky here. We're going to go to 50 basis points. And then they say, well, that's not enough. And they do 4 75 basis point increases. And they didn't take any time to understand the roots of this inflation, and that their traditional tool of raising rates is ineffective. Raising rates is effective if you have too much demand and you want to slow demand. You want to slow people from buying cars and slow people from buying houses. That's not what we have. We have supply chain inflation. And when you raise interest rates, you further recede or adversely impact supply chain. And so the business is trying to build a warehouse and build out supply chain. It needs to borrow money from the bank. Those rates are higher. They can't do it. Or small business, which most of their lending are variable rate, they get crushed and they pull back. And so the Fed is waiting to see 5% unemployment before they stop. They're not going to see it for a long time, because even with these layoffs in the tech sector, those layoffs get a severance benefit, and they don't get counted as unemployed for 6 months or more later because they're not eligible to be classified as unemployment. So the unemployment that the Fed wants to see, and maybe sees this summer or this fall, they will probably already done 4 or 5 more interest rate increases. So their goal was, well, we'll go to 5, then we'll go to 5.5. Now they're talking about a 6% overnight lending rate. They're below 4 3/4 today. So at this March meeting, forget this 25 basis point talk. I've been telling people since their February 1st meeting, when they did 25, that was a mistake. It should have sustained 50. and they're going to have to go back to it. And so what happened 2 days after their February 1st meeting? We got a jobs report of over 500,000 jobs. What do we get this morning? Another hot jobs report over 300,000 on the heels of ADP yesterday. What do we get in the next 3 weeks? We got a hot CPI number of 0.5% in 1 month. We got a hot PPI number that was 0.7%. Their favorite PCE, consumer expenditure inflation, was 0.6%. Every metric is as hot or hotter than it was the first half a year ago. So what happened last summer and fall that caused everybody to think inflation had peaked, the Fed could quit raising rates, was the Strategic Petroleum Reserve. So the first half of last year, we didn't have it. It's strong inflation, and we had negative GDP. Then GDP went positive in the third and fourth quarter because releasing the Strategic Petroleum Reserve, that 190 million barrels of oil, that's positive to GDP. So it wiped out any of the negative that we were seeing. It brought inflation down on the energy sector side. So that masked all the other inflation. And now we're done. We've depleted our reserves. So now it's time for China with the space balloon. They verified it going over the earth that we have no more reserves. That's what they were really checking on. or why all those people were moving in the U-Haul report. And so now we see the energy inflation coming back up, oil back in the $70, $80 a barrel range. And so we're going to add the energy inflation. So it's what I call super core inflation. So it's services, it's wages, it's food, and it's energy. And you look at those four, they're all above 10%. And the Fed, in all that they're doing, does nothing on it. So what are one or two tools the Fed could use that wouldn't be having and putting us into a recession? One is work on the balance sheet. So working on the balance sheet doesn't do anything to the small businesses loan rate or the credit cards or the mortgage rates, but it starts to take that $9 trillion that was printed money from the Treasury and gets it off the balance sheet. And remember what the Fed was doing during COVID? They were even buying corporate bonds. They'd never done that. They were buying New York Water Authority and Transportation Authority bonds. Put those things back into the market and don't raise rates. So the credit card stays low, the mortgage rate stays low, but you're sucking up money supply. You're having another way to get it out of there to drive inflation down. The other one is, which they haven't used in a long time, it's called IOER. It's interest on excess reserves. So the banks get paid by the Fed to either hold reserves and not lend, or to not hold reserves. So when they wanted the banks to lend through COVID, they took those reserves down almost zero and said, get the money out, lend. Right now, if they would say to the banks, we're going to pay you 5% to not lend. Okay, then you pull back that money supply, but you don't raise interest rates, you don't affect mortgages, and you make other capital have to come and work efficiently into the market. Those are two tools they've forgotten about, or they lost somewhere, out in the garden shed. But the interest rate thing is not going to affect this type of inflation. And I'm very, very critical of it. And that's why Judy Shelton is one of my favorite people on the Fed. She was nominated to be a vice chair and Fed governor, but because she was too common sense, too candid, and too truthful, they didn't put her on. But she appears about every other month on CNBC. She was on this week, and she's just spot on this and how the interest rate tool isn't working. And we've got to look at these other tools. But remember who Jay Powell's mentor was. It was Paul Volcker. He's following the original Volcker rule, which is just destroy the economy and become the most hated person, and that's okay. That's the track that Jay Powell's on.
Yeah, I mean, we haven't seen interest rate movement like this since the early 80s when Volcker was in charge. I think the one thing Powell seems determined not to repeat is that Volcker dropped rates quickly and inflation came back. And I think Powell is determined to hold the line as long as he can. He's been very vocal about that. So these things aren't coming down anytime soon. It goes
from 75 to 55 to 25. Now he's going to have to go back and reverse that 50, 75. So he's kind of doing that. He's not really fully learned the lesson. He didn't cut him, but he's reduced the pay. So either just, like Jim Bullard, my friend at St. Louis Fed, Jim's very good. He's been all over this inflation stuff. And Jim Bullard said, look, just rip the Band-Aid off. Just get it over with, shut it down, get the psychology. Don't make it long and drawn out. But Powell's making this very long and drawn out. And remember that 99.999% of the Fed is academic. They've never made a loan, broke a loan, fixed a loan, bought a car, bought a home. And so they don't understand how these policy initiatives work. So when I was in the Fed 2005 to 10, I thought, well, surely they know about housing and construction loans. And what I learned was they had no idea how a construction loan worked and this thing called an interest reserve. So they didn't think that the housing crisis would spill over into commercial because all these banks had this facility that kept funding money to condos that weren't selling or subdivisions that weren't selling. And I had to raise my hand and said, has anybody heard of gap accounting? That's an impaired loan, and it's called an interest reserve. And no one doing all the stress tests that were delayed in 2009 had ever understood an interest reserve, and that runs out after 12 to 18 months. And that's why commercial real estate would follow residential into the toilet. It took about a year, and some examiner got mad at me about that. So he leaked my presentation to the Wall Street Journal. And so it was an interesting time when they did that, because on a Wednesday in like October, it said, CRE or Fed CRE expert says, slow to recognize losses. And here was my whole presentation. So they thought I did it, but they found out it was some other state bank examiner. So they gave me back all the computers and electronics in my home after they seized them.
Wow, that is a wild story. Okay, you predicted last year interest rates climbing to somewhere between the 4% and 5% mark for the 10-year Treasury. As of the recording of this podcast, middle of March 2023, you're spot on, right at 4% right now. So it's a very accurate prediction. Where do we go from here? Because you just talked about the need to continue to drive this home, or the desire, I should say, of the Fed to continue to drive this home. So where do we net out this year, Casey?
So my fear is the 10-year Treasury is becoming largely irrelevant, because if you look at the Fed's balance sheet, they're still supporting the acquisition of the 10-year. So they're artificially keeping it from rising, but they're not supporting the 2-year Treasury. So that's why we've seen more rise in the 2-year over 5%, and that spread in the inversion. I think in the last week it went to like almost 110 basis points, which is just really dramatic. So we'd seen it 30 to 40, then it went to 50 to 70 at the end of last year. Now we're in that 70 to 100 basis point spread range. That's a really severe inversion. And what that's telling you essentially when you see that is that the marketplace at large sees really bad, ominous things for the next 2 years. And they want to be paid for that. And they're hoping they're not going to be bad beyond 2 years. And so they're living in Hope, Arkansas, instead of Hope reality. And so I would watch that inversion and watch the Fed's balance sheet, because the two things the Fed's supporting right now that's keeping us from a complete implosion is, one, they're supporting the 10-year Treasury, which a lot of our mortgage and real estate prices off of. And the other thing is they're still supporting mortgage-backed securities. So they're buying it. And if they ever pull back and start to not buy the mortgage-backed securities, we could see a real problem in both the multifamily and the single family. Those are two things that are going on behind the scenes that they're manipulating. And so I've kind of almost tried to quit trying to forecast the 10-year. The 10-year should be getting closer to the 2-year. That inversion should be getting closer and closer. Yep. But I think the market is still in a place of hope, and they just think we have to get through 2 years of bad stuff and be paid for it. And then we'll go on from there. The other consequence for the banks in this is deposits are leaving the banks pretty dramatically. So, and there's two current stories. We had Silicon Valley Bank implode today after the other Texas currency bank, and then the FTX thing. And I think this could be like the Russian ruble hedging crisis that we had in '98, and that we didn't know what was going on and how embedded this was. But what's happening is, why would I leave my deposits in a bank to get paid 2% on a CD when I can go get a 1-year or 2-year Treasury paying over 5% and have no risk? I have no market risk at all on that side. And so we're seeing the deposits leave pretty dramatically. So the banks are losing deposits that should enable them to lend and have capital. That's what happened with partly Silver Lake or Silicon Valley Bank out there in the Silicon Valley, and had basically a run on the bank. The second thing that's happening is that the credit problems are starting to develop in the banks. And so they're going to have to continue to raise loan loss reserve allowances. In the latest stress tests results, or what they want to do for this year's stress test, TREP covered this, is the test to the banks is assume a 40% reduction in commercial real estate values. So if you got to build up capital for a 40% decline in commercial real estate values, one, you're not going to be lending on it. And two, you're going to have to build up a lot more reserves at a time when deposits are leaving your institution. I really fear we could begin to see a lot more like we saw with Silicon Valley Bank this morning. We could be on the early stages of a bank failure cycle here. And whenever the Fed dramatically raises interest rates, it has a very adverse impact on the banking industry. And so I worry that the other dot we're not connecting here is really what's ahead on the banks. Where do they make profitability? Where's their net interest margin? Where do they put assets to work? Where do the deposits go? It's not a good story at any level on the bank side.
Yes, that kind of begs the question, I think, for investors: where's the liquidity from the banking side in the market? And maybe right now it feels like Fannie and Freddie and Life Cos have the liquidity and the banks don't. And CMBS is pretty defunct right now as well, based on how their other assets in their portfolio are operating. So tell us about that. You put on a hat. Tell us what
put on my hat.
here.
This is my banker hat. He used to have nice, combed hair and it was brown and it was full. And so now he's got to put on his baseball hat with crazy hair and put mousse on. They're gonna make them all gray and bad hair days ahead for the bank. Is that what I've got? So this is my bad hair day. When I go visit my bankers, I put this in my backpack and I pull it out and say, okay, you want to know what's ahead? Bad hair day for the banks. And you're right. The liquidity without Freddie and Fannie, that's what's always made multifamily unique. We have this unique liquidity tool that you don't have for any other property type. And it's largely supported by the Fed, putting a lot of that on their balance sheet or supporting it. And if any of those underpinnings come out, the Fed pulls back, or Freddie and Fannie, have a change and whatnot, it's not good news. So this is really going to challenge Freddie, Fannie, and the Fed on what are they going to do for housing support. And we don't know the answer there. The Powell won't answer that question.
Yeah, that's a very pertinent question. Okay. All right. So I think let's bring it home a little bit. If you're an investor in multifamily or manufactured housing this year, what's your recommendation to those people? What kind of action should they be taking? Should they be buying? Should they be selling? Should they be recapitalizing? Should they just be sitting on their hands? Like, what should they do? They're looking for guidance.
Yeah, it's a stressful time. So the term that I think we're going to be so worn out with by the end of the year is called maturity risk. So anybody that's got a maturing loan in the next 24 months, you should have been getting prepared because now you just need to get scared. The underwriting's different. So what I tell people, the appraisers don't know what the cap rate is. They're review mirror guy. I'm a third generation appraiser.
Right.
They use that fourth approach to valuation, which is they average every comp and say, there's your number. They don't understand the uniqueness of your property or your market. So forget the averaging technique, forget cap rate comps from things that sold 6-12 months ago. Do a band of investment. Go dust off all your old appraisal and CCIM, investment management skills, and look at what a cap rate should be based on the cost of your equity and your debt. And so if you go back a year ago, you could easily construct a cap rate in the 5 range based on your cost of debt and equity. You get 70-75% loan to value. The 10-year treasury was below 3%. Everything, your debt service coverage was manageable, all those things. And so when you layered in the equity and the debt, you could put together a 5 cap rate. Fast forward to today, I can't get below 7 3/4 on anything. Not a great warehouse, not a multifamily deal. When you look at what's happened to the rates. And so what we haven't seen yet in the market that's ahead of us is what's the repricing and value of real estate when you go from a 5 cap rate to a 7 cap rate range on almost everything. And the answer is that's a 25% reduction in value. So anybody that's underwriting today, they're underwriting using a band of investment cap rate because there aren't going to be enough comps and they want to know what the cost of debt and equity is, or they're doing an interest only. And the interest only isn't going to be 7, 8, or 9, it's going to be 10 or 11. And if you just layer that in there, you lose 20 to 25% of what you can borrow on or whatnot. So I think that's what's ahead of us. Where I think the numbers are, that's an opportunity because it means as capital dries up, we have a big disconnect between sellers and buyers. And in fact, in the 2023 Urban Land Institute Emerging Trends Report, the number one conclusion across every ULI member was there's a huge disconnect between buyers and sellers. Sellers still think they're in 4 and 5 cap rate range. Buyers are saying, I can't pay you anything below about a 7 cap rate. And so we're going to spend a year here with that friction trying to figure out where we educate. And I think the band of investment on a cap rate is a great tool. When I sit down with 2 parties and they're very far apart and I show them that and say, that's the reality. And you can sit here, in denial land, Disney in in Egypt or whatever, or the Denial River, and you're not going to be able to sell the asset. And in the meantime, you're going to see your expenses growing at 3 times your rent growth rate. You're going to see rent growth rate slow dramatically because people don't have the income and the resources, and we're starting to see job loss. And what do? We move downstream from an A-class property to a B-class property, just like we used to do in office or retail. And you're going to see the same shift in movement. So where I think the money and the opportunity is look at that U-Haul report. Where are people moving? They're moving to the Intermountain region. They're moving to the Midwest, like in Ohio, that has good jobs and affordability, or they're moving to the South. And so they're moving there, and their rent numbers, even if they've gone up 10%, are still 30% less than California or New York or even Chicago. So I look at those markets that U-Haul report where they're telling me they're moving. I look at their affordability numbers that are there. I look at the job creation that's occurring there. I look at that the assets are pretty good. There's mainly older assets, so they're bigger properties. They have 2 and 3 bedrooms. They didn't build many 1 bedrooms in those markets. So you've got that extra space to have a remote work office or a roommate plan. And those ones that are close to cities that have good airports that can connect you. So if I've got a remote work, but I got to go to the West Coast, or I got to go to Chicago or New York or somewhere for a meeting or a conference, I can get on a plane. So a place like, Huntsville, Alabama, a Colorado Springs Airport, a Phoenix, Great Sky Harbor Airport. You look at those, Tampa Bay, for example, is a good, right near downtown, affordability. I look at that combination of things, and those are the markets that tell me I've got remote airport transportation network. I got affordability. I've got larger value add units that are an opportunity that, compared to, say, the West Coast or the Northeast, I can still buy those assets in $150,000 to $200,000 a unit range and put 50 in them. And I'm below the replacement cost, which is about $350,000 to build a new stick-built apartment. And that number will work all day long. And I think you can get equity capital to come in and work with you on that model. But nobody wants to do a new one because, one, you don't know what the costs are going to be. You don't know how it works at $350,000 a unit when that was the median home price 4 years ago. And now that's the median cost to build an apartment. And the two other things that we've got going on, we have all these empty office buildings that are going to be candidates for repurpose, adaptive reuse to multifamily. So how do I know that shadow inventory is going to play? Just like we used to think the shadow inventory in residential, we have shadow inventory multifamily, which are empty office buildings that could be repurposed to multifamily in markets like New York or Atlanta or Dallas that are happening. The last one I'll point out is a pretty scary statistic and a good opportunity. So John Burns, who's a great housing economist out of California, I've known him for many, many years. I brought him into the Fed when we had problems to help advise. So he just did a report recently, and he said, you want to guess what the number is for the number of homes under construction in America that are priced under 250,000? Zero. Zero.
Really? Wow.
And that
I
used
like
to be,
John. I had him on the podcast last year, and we talked about the spread of renting versus owning, and it was the highest historically at the time. 6 months ago, it was over $800, Casey. It was significant.
Yeah. So he's spot on. And that used to be 20% of our multifamily construction mix. You go back 5-10 years ago. And so there's only one housing type under $200,000 that you can deploy today, and that's a manufactured home. So I sit I'm an independent director on a public REIT known as UMH. We have 130 communities. It's 53-year-old REIT. All we do is build these communities, and they're great. I mean, these are 1,400 unit square foot homes. They're built, to withstand the standards and maintenance requirements of driving down the road at 70 miles an hour. We just built our newest community in Sebring, Florida, which is where Hurricane Ian went over. And the only damage we had was a few palm trees knocked down. No roofs, no windows broken, no damage.
That's great.
No one.
Yeah.
And so it proved this concept. Well, we can put you into one of those. Our land costs, acquisition site development's about $30,000 to $35,000 a unit. We buy the manufactured homes from Berkshire Hathaway's Countrywide Homes. We just did 800. We bought 800 units. We buy them at about 80 to 90,000 a unit. So we're all in around a 120, 130 range. And so even with profit and all the fees and everything, you're maxing at 150. We just got approved the first Fannie Mae mortgage for a manufactured home. First ones to ever figure out how to do it.
Wow.
Get it done.
Congratulations.
So it's 4.5% fixed money. So we can put you in, even in the most expensive market like a Florida, at under $180,000 with an all-in. You can rent, you can own, we'll do whatever model you want, whatever mix, and you're in all in at under $1,000. So the one in Sebring, we leased it up about 40% quicker than we thought, or sold it out. We did most of it as rental. And the pro forma rents were about 20% higher than we thought. And our main population wasn't who we thought. It was all the medical staff at the nearby hospital, nurses and doctor residents that couldn't find an apartment, couldn't afford an apartment, couldn't afford a house, but they love this. We put in community centers, sidewalks, community amenities. And so manufactured housing, I think, is going to be one of those ones where if we go back to the textile mill days, where the textile mills built the villages around them, we're seeing that factories and people like Hyundai and VinFast out of Vietnam are coming to us and saying, if you'd build us one near our new factory that we're building, new EV car plant, we'll master lease the whole thing. And when we're getting the site selection approval from the governor of the state, we'll mandate that they already go ahead and give us the zoning. So Mayor NIMBY, not in my backyard, can't screw with us. And so I think manufactured housing and more density. The only way we're going to solve this affordable housing is the land's too expensive. The entitlement process is too long. So it's density. And all of the elected officials, they get kicked out of office if they allow more density or something like a manufactured home, because they think it's going to attract tornadoes and criminals and every bad element. When really, when you look at the demographic mix, this is where your teachers, your police, your fire, your retail, your hospitality workers, because they can't afford the legacy single family home. So I think if we don't really get serious about addressing affordable housing, we're going to see the political divide between the haves and have nots, and the frustration and the ability to have economic growth grow farther and farther apart. And this is an area where the Fed could make an impact on monetary policy and to the banks with updating, Community Reinvestment Act stuff, and making incentives and carrots for the banks to lend into the affordable housing, and really putting the pressure on Freddie and Fannie as well.
Yeah, that's your Sebring example with the hospital employees working there. What comes to mind is that's true workforce housing, right? And that's such a need right now and has an affordability component. Such a large percentage of our workforce population needs that. The police, the teachers, the nurses, and just a host of people, right? That's a really interesting case study. You mentioned VinFast. It's obviously a North Carolina project, and we're proudly watching that. I noticed yesterday in the Wall Street Journal, Elon Musk is trying to build his own city in Texas around a manufacturing plant. So I do think that feels like it's coming back in vogue, where employers are going to start to want their own housing nearby for the best employee experience. And that'll be interesting to watch going forward. It's been a long time since we've had those days of the textile mills building towns.
And think back, the 1960s and 50s, the way we recruited employees is we created something called a healthcare benefit. And that made employees want to come to work for you because you provided healthcare. Mm-hmm. And then it got out of control and all messed up. We're seeing today, I think it's going to be a housing benefit. So the factory and whatnot that can provide you that affordable housing to come along with the job and everything else, it's going to become more as important a benefit as a healthcare benefit. And we kind of already see that in Mexico. You can get a peso denominated mortgage in Mexico now. It's so stable. Really? And they take it out of your pay, just like we take out our tax withholding, they take out the mortgage withholding. So if we don't fix it, and what's happening is we see this population move and the workforce and the employers move from California and New York to affordable states, we're making what was affordable locations not affordable. Look at Salt Lake. The median home price is over $500,000. Look at I was just in Bozeman, Montana. It's almost unaffordable. There's more gazillionaires living and walking around Bozeman, Montana than there probably is Carmel, California. And, look at the cities in Florida, or even look at us, here in Georgia or Huntsville, Alabama. They're becoming unaffordable because there isn't the supply. You can't make the numbers work. And these construction costs aren't going to work. If you take the latest CPI and PPI data apart, the category that it still has the largest increase in cost is construction. It's over 20%. And so that's not fixing it. And then the next one is food. So it's so, like I call super core. We have core and non-core. Throw those out the door. Look at services, look at wages, look at the shelter costs, and look at energy. And those four are all above 10%. And that's what we spend 80% of our money on in our household.
Multifamily Method is powered by Capstone Companies, the largest privately owned multifamily investment sales brokerage nationwide. Capstone Companies provides dedicated coverage to both primary and secondary markets throughout the Southeast, Mid-Atlantic, and Midwest regions of the United States. Whether buying, selling, or refinancing, Capstone Companies is here to help. Simply put, Capstone is expertise, experience, extra mile. If you're interested in having Capstone provide a complimentary opinion of value on your multifamily asset, please visit us at capstone-companies.com.
Yeah, and I have a question. I wonder at times if the Fed has the wrong target in their sights. I know they're targeting inflation, but they also are very focused on unemployment. And there's a part of me that wonders if the labor force participation rate being down is going, and our net migration and birth numbers being down as well, Casey, have led to an underwhelming size of our workforce, which will always depress that unemployment number at a low number. So are you chasing a false narrative there, a number that you really can't fix, is kind of my question at this point.
I think you're spot on. So you look at the barbell of our labor force. So those that came into COVID near 60, they've left. They've gone. They sold their house. They moved to more affordability. They took advantage of their retirement. They took Social Security while it's still paying, because it may not be for a number of years here coming forward. And so they've gone. They said, I don't want to commute. I don't want the risk. And I'm just going to readjust everything in my lifestyle, where I live and how I function. And I'm not going to do work anymore. I'm just done. I'm done with it. So that whole people that were staying till 68 and to 70, it's now 62. Mm-hmm. So anybody over 62 is pretty much leaving the workforce and not coming back. We're not retaining that. And then at the lower end, so I have two millennial daughters that are 21 and 27. And, you know, they worked, one was bartender in a college town and made $50,000-$60,000 a year. The other was working for the Sarasota Symphony in Sarasota and couldn't work or make it work and whatnot. And what they said is, you know, we're in these industries that aren't paying well. So hospitality, retail, teachers, it's horrible after COVID. You look at hospitality, you look at retail, try to go into a restaurant, try to get a cashier to check you out at the grocery store. I feel like I should get an extra coupon for having to find the things, put them in the basket, then go to the checkout, take them out of the basket, put them back in the basket, put them in my car again, and go home. It's like 5 times I got to handle I should get a coupon for that. But there's none of that workforce. There's no parking lot attendants. There's no cashiers at grocery stores. And so that young workforce has said, that didn't pay well. It was awful. And I'm not coming back. I can go work a few hours at night at Amazon. I can make $18, $20 an hour doing remote work as a call center or something at home. I don't have to worry about healthcare. I'm in daycare. I don't have to worry about, you know, if I've got young kids, you know, how do I deal with them? If I got to take care of a senior elder parent, I can be at home. I can work remote. I don't have to commute. I don't have gas costs that have gone way up. And so they're done. They're not coming back to all these sectors. So how does business usually deal with that? We turn to technology. So look at all of the applications of technology that are erasing labor. So when's the last time you saw a parking lot attendant? Not. When's the last time you saw a retail checkout person? Or at a restaurant, you go in and there's 2 wait staff and there's 50 empty tables, and now they're putting devices on the table where I can order, I can check out, and all they really need is someone in the kitchen to make the food and walk it back out. We get rid of all that staff. Look at even on education, we could do remote work, and many of the colleges and universities were doing. My daughters still have Zoom classes that they're doing, that nothing's in person in the dormitory or on the university level. Look at warehouses. There are not forklift drivers anymore. They're all robots. Every element that we can't hire for, we're turning to technology to replace that workforce. And so we could probably function at a 60% or less labor participation rate. And I don't think we'll ever see 65% again. And I think that within the next 2 years will be 60% or less as the new norm. And it'll all be technology that we're doing. Look at the ports. The gantry cranes on the East Coast are all robots. The paperwork is all automated. We're looking at autonomous truck driving. The state of Florida implemented all of the legislation to allow statewide autonomous truck driving. So when you're going through Orlando and a rogue autonomous truck runs over your family, okay, you get $10,000 for the dead dog. You get $20,000 per limb that's, you know, destined. They've defined all of this stuff so the attorneys can't come in and litigate you into oblivion. And we're going to see this autonomous trucking between Texas and Arizona next. We're going to see it move horizontally across all the interstates. But business finds solutions to workforce disruption by deploying technology. And we've never had the robotic type technology more than we do right now to deal with a declining labor participation rate. So I think you're right. If the Fed's looking for unemployment because of that, or looking at the labor participation rate, they don't understand what's going on or how business deals with inflation.
Well, I think you make a super insightful point about how business supplements technology to replace that labor pool, because I agree with you, it's gone. A couple thoughts here. One, it appears to me we're following in the footsteps of Japan, who had an aging labor force and then got really tech heavy and really figured it out there. I feel like we're a few years behind them. And two, not only for some of the blue collar jobs like the factories and the trucking, But for some white collar jobs, think of things like Chat GPT. So for us, if we're doing an offering memorandum on a deal, why can't we do market overviews and updates about statistics in the market, all public knowledge? Why can't Chat GPT write that and someone just reviews that? Why do we have humans doing that? So a lot of this stuff may be software driven too in the white collar sector. So I think the technology will be ubiquitous. One asset class, this is not about self-storage, but I am active in that asset class on the side. I know a number of operators I've done deals with that have fully autonomous facilities. There's a kiosk when you come in. There's a person on a phone in the call center on a camera. There's nobody on site. They send the maintenance guy once a week to make sure the locks are good and there's no raccoons in the trash bin or whatever. But you don't need a property manager on site. And I think multi will see that day someday sooner than later. Multifamily hasn't got there yet, Casey, but I think that change is coming where a robot or a technology software will check you into your apartment.
No, you're right. So I work with a company on a lot of different angles. They have, I'll use the big, one of their biggest markets is Philadelphia. And it's called Easy Storage. And so it's all, you drive in, you just don't have a covered area. They have robotic code doors where you drive in. It's all camera, all security stuff. It all goes to different control centers. So security has cameras that are monitoring every place. At every locker, if you sign in and your code says your locker is on the second floor, you know, unit 102, and you go to anything other than 102, a security alarm is set off because you're screwing around with somebody else. They know exactly what you're doing. It's all on camera. Every bit of the maintenance, they've got every sensor that you can imagine. So even with the cars going in and they close the doors, if the carbon dioxide gets too much, it kicks on the extra fans. But you know, they don't need labor. All of this technology, security, it's all there. And so they're driving their expense ratios down instead of having all this redundant labor at every single facility, you know, 30 throughout Pennsylvania. It's one center that can do all 30. And that brings those expense ratios down. So when you look at the Class A self-storage, the climate control, the stuff that the REITs want to buy, that's what they're doing. It's just like hotel. Hotel has figured out during COVID how to reduce their expenses by 25 to 30%, because now what we do is we use our smart device. And I'd say half the hotels I check into, I check in, I get a QR code. I don't need a key anymore. My code opens the door. I can send any kind of message I want. They don't do maid service every day. They may deliver you a package at night of 2 or 3 more towels. But I don't get maid service on a daily basis. They've gotten rid of all the food and beverage because I can go on Uber Eats and have something delivered and go down and meet it. So you got rid of all that staff, the kitchen, all of that type stuff. So I think just like hotel, self-storage has figured that out on the Class A, the climate control stuff. And we're going to see this permeate really every asset type. And I think you're exactly right on the multifamily, just like the self-storage. If you want to rent a unit, you can't find a real person. It's all online. They'll access it. They'll, you know, you get to the place, they'll unlock the code. They'll give it so you have so much time to go tour. They'll unlock a building, the lease contract, your rent payment. It's all automated. And so I think we're going to see this stratification of self-storage, just like in manufactured housing. It was largely mom and pop, and mom and pop is becoming REIT invested, you know, institutional money, where they bring these efficiencies and wring out the excess expenses, and that's how they make the better margins. And so you do that instead of office or instead of retail. I'll give you one other statistic on the retail side. So I work with some of the big box clients that are still very successful. One of them in the home improvement space. One of our last industrial deals that we did in our Monmouth REIT was for one of these entities. And they had us build their newest, most modern e-commerce fulfillment center here in Atlanta. And we were talking to them about, well, the costs are going up and the cap rate might not be what they expected. And they said, stop. We don't care about the rent. We don't care about the cap rate, because when we open that thing, if it's right, we can close 100 big box stores. I don't have the redundancy of real estate, people, or inventory, and I can deliver from that location to about 40% of America and about 80% in the Southeast within less than half of one day. That's what it works for me. And when you do that, I could do a 1% cap rate deal. You could double the rents. I don't care. I need that e-commerce efficiency. And if I can do that one building, that's what works. So imagine all those efficiencies. And that's why we're seeing this build out, and even Walmart and Walgreens closing stores this year, because they figured that out. And they're using the e-commerce model to have a central location without redundant inventory, without redundant real estate, without redundant people, to execute on the retail model. And so it's I think we're at the beginning stages. This is a watershed event, just like when the GIs came home from World War II and we didn't know what to expect. And they said, we're not going to go back home and live with mom and dad. We're going to go to this thing we call a suburb, and we're going to create this new thing called a regional mall. And that's what's going to drive real estate for the next 3 decades. We're at that kind of event right now.
Yeah, in that regard, it's really an exciting time. So tell me a little bit about what you're up to at Red Shoe Economics these days and what you've been active with. I'd love to hear that.
Yeah, so I'm really looking forward to next week. My mom was in Ireland. I came from an Irish family, so I'm looking forward to St. Patrick's Day and not talking about real estate next weekend. my futurist hat there. One of the neat, fun things, so I do a lot still in ports and logistics, a ton of that. And it's really about, if you don't know how your port hip bone connects to a rail leg bone to your city highway bone, you don't understand supply chain or how industrial is going to work. If you don't understand things like the U-Haul migration report, you don't understand where the population is moving, where the opportunity is, because if you can have 7% population workforce growth, you can outrun 7% inflation. So that's what you really need to figure out. And that's inland, interior, and secondary markets. The third thing that we're working on a lot, I do a lot on adaptive reuse. So what do we do with these empty office buildings or empty malls and big box stores? So we do a lot around that. And this is a incredible opportunity, especially in the space of affordable housing. We can do a lot with these big buildings to deploy. We're going to have to do a lot more, say, around convenience stores and gas stations. When you look at the trajectory of EVs, who's going to stop at a convenience store anymore if I don't need to refuel? Right. So I'm recharging at work or home or somewhere else. So I think the new Tesla model is going to be one that has a pop-up trunk where a porta potty unfolds out and I can discharge while I recharge. I'll buy that EV. Maybe they call it a PV or something, an EV PV or something like that. But the other one I'm really excited about is the space economy. So we're doing a lot on, we trademarked a term called spacenomics. And the space economy today is about 1% of our GDP. We've been working with the Bureau of Economic Analysis to figure out how to strip out what is related space economy. And we think that's going to be 10% of our GDP. And they're going to probably be 5 to 7 dominant states. Florida may surpass all of them, Texas and California. There's going to be Florida and Texas and probably Colorado. Florida will do 90 private space launches this year, more than all the states combined did over the last 5 years. It is just and think about trying to supply chain and engineer staff to do 90 launches. I mean, you're talking about, almost 2 a week, all the logistics, and they're going to launch this weekend the first 3D printed rocket ship. So they can put these things together in weeks rather than months. And they're working on that the propulsion in outer space is no longer going to be a combustible rocket ship booster. It's going to be a pair of electric batteries that just quietly, with no emissions, shoot you like a Tesla into the universe, straight up into the air. And so when you look at all the things that have to happen for that, and that companies now, today, can lease a tile on a private satellite to manage their whole cloud system and all of their data and not have to deal with Amazon Web Services, how is the laws on managing that, repossessing the tile if you don't pay your rent? Which state's law covers it? If you launch from Florida, that satellite, is it Florida law? If it's Texas law. Pray to God they don't launch in California, because you'll never figure all the laws out, right? They're so complex. And then think of all of the assets on the ground that have to support that. And my best example is go look at Long Beach right now. So all the former, Boeing type stuff has all been repurposed for all these private space companies to do all the engineering and the coding and the supporting of private launch space out of the Port of Long Beach. And I mean, it's millions and millions of square feet and thousands of engineers. They just can't afford to live there. But think of all that real estate that's got to support this space economy. And then how you manage the economics of space real estate, which is going to be a satellite versus a building. And so we're working on all of that and defining that. And we think that's going to be exciting. Places like Florida, Texas, Colorado, Northern Alabama, like with Huntsville. California will stay relevant. It'll stay big now, but I think it's losing a lot more because of the affordability. So we'll have that out hopefully by the summer, but that's a real exciting. I like looking forward. We did a lot of the original work on adaptive use and still a lot of fun with it. I've got the largest database in the country, over 40,000 adaptive reuse projects, which is more than all the self-storage industry, but we still don't have our own property type in CoStar. Go figure. And maybe we could get a Fannie Mae facility for adaptive reuse along the way. But so we try to stay positive, the opportunities, adaptive reuse. What do we do with all these convenience stores and gas stations as we become more of an electric vehicle facility? What do we do with all these branch banks? Last year, banks closed 3,500 branch banks. They're going to close more this year because I can't remember the last time I was into a branch bank. It's been years that everything I've needed to do probably was when I sent my last daughter to college and I needed to co-sign setting her up for a bank account. You literally had to go in and get re-fingerprinted, but everything is here. I can do everything I need on this device and never go into a branch bank. So they make great adaptive reuse remote offices. So we have companies and tech companies that say, here's where our employees live in the city. We need about 15,000 square feet. Could you find us 3 closed branch banks near where our workforce is? And that's where our new remote work is going to be. It's just tremendous opportunities in all this disruption.
That's interesting. Yeah, there is a ton of opportunities there. Well, you're working on a lot of exciting stuff. All right. So last but not least, from now to the end of the year, what advice would you give to our multifamily manufactured housing investors? I'll remind you, last year you said, if you're going through hell, keep on going. That was your final line. So what do you think for 23?
Yeah, I've got the quote. If you're going through hell, just keep on going. Don't stop and get your feet burned. So I'd say really understand this LTC thing: location, timing, and capital. And there's a lot of money that thinks maybe we're at the bottom, maybe inflation's peaked, maybe the Fed's through raising interest rate. They're not. This is not the timing. You need to get ready for the timing, which I think could be 6 to 12 months out. Work on deploying that capital. But if you own an asset, if you own multifamily assets today, your MVP employee is your property management. Those are the entities that are going to help you figure out how to manage this out of control expense growth, that figure out the strategies and how to do it and know what's going on in real time. Because if you don't get this 10 to 20% growth rate in expenses at your multifamily communities back into single digits, you're not going to get 10% rent growth rates. Those are gone. And you're going to see tenants downshift. And if you've got capital to employ, I would strongly encourage you to look at secondary and tertiary markets, because those are the ones where the assets, the capital never naturally went there. They didn't get the benefit of really low cap rates. The numbers work. You won't have new competition because nobody's going to be able to afford to build. So, you look at those places like, Tucson, Arizona, Colorado Springs, in Alabama, Montgomery, where we just put the new inland port and we're getting a second Hyundai plant. And it's going to be, kind of like when Jim Newsom said, let's do the first new inland port in Greenville, South Carolina, or Greer, South Carolina, near Greenville and the BMW plant. Look at the interior part, the Central Florida, the Winter Haven market, where all the logistics is setting up, and all those jobs are at Nucor and Publix and Home Depot. So it's between Tampa and Jacksonville. Tremendous job growth opportunity, older assets, or where you can still afford to build. I think that's the opportunity, and to be scouring, who are the brokers that know that. So I'm biased. I love Colliers as their chief economist. They have a great young guy there by the name of Will Matthews. And all he does is multifamily and secondary markets and value opportunity deals. Find those entities in your market that know that multifamily. That's where the new capital can go and make sense. And the cap rates can be 7% and you still make a good return. I don't think you can afford to build right now. The numbers just don't work. And now with the cost of debt, and then the bank's not wanting to make a construction loan. They're starting to talk about, now with this Silicon Valley Bank failure yesterday, that we could see around the bank failures. And so when they look at it, I just briefed both the small and large bank regulator community on commercial real estate. And I reminded them, we have commercial real estate concentration still in many of these banks. It bloomed more in COVID, and none of the banks were really paying attention to refi risk. How do these things refi when they were underwritten at 4 and 5 cap rates and now it's 7 or 8? They don't refi very well. So you're going to have those maturity defaults. And so the banks aren't going to set up workout departments again. It's too inefficient. And what they learned during COVID with hotels, they just bundled all those loans together, threw them out in a bag to Wall Street and private equity and said, bid on a bag, and we'll just take what we can. We'll take 30, 40, 45% reductions. We'll be done. We'll hit the capital, and we won't have the cost of this workout department, which when you do the historic studies on workout departments in bad real estate times, 1/3 of your loss was building and setting up and staffing a workout department. So they're not going to do it. They're going to be more efficient. They're going to go directly to Wall Street and say, here's a bag, grab the whole thing. You can't cherry pick it. You figure it out later, bid on it, and we're done. And they've got the capital now to take those hits and then maybe not have to rebuild it because they're not managing that all the way through. So I would say, look at your maturities right now. If you got something in the next 24 months, you got to find a good person to help you on the capital. You're going to need more equity. Debt's not going to be there. And so that's the real strain that's going to come ahead. If you're looking at new money to deploy, I say it's those secondary markets. New construction is not going to work, and you're going to see the market go into timeout mode for the next 6 months. They don't know what the Fed's going to do. So if they do 50 here next week, do they do another 50? Do they follow it with a 75? What happens to inflation? We're not going to know for 6 months. And so I think that uncertainty leaves the capital markets locked up, at least until late summer, early fall next year. So if you need capital, it's going to be a challenge. If you have it, you can buy whatever the hell you want.
Yeah. Definitely appreciate your time as always, my friend, and always appreciate the insights, and let's catch up soon.
Yeah.
Thank you for listening to Multifamily Method. If you enjoyed today's episode, please give us a rating and a review on Apple Podcasts. It helps our podcast get discovered by other savvy investors like yourself. Subscribe to Multifamily Method for free on your podcast platform of choice. Find out more about Capstone Companies at capstone-companies.com. Multifamily Method is executive produced by Capstone Companies. Audio production for the podcast provided by Andy Go of Gojo Studios, and video production by Yash Mistry of Mystery Projects.